All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker SHEL, SHEL, formerly Royal Dutch Shell. Recently did their consolidation of their different class shares, the A and B shares for the RDS ticker, and recategorized it into the SHEL, SHEL designation, which both simplified it into one structure and also gave them a nice neat little shell name right there. Oh hey, welcome in, getting into shell today. So this is another company that's been a holding of ours for a few years. We were holding it prior to the pandemic, and it definitely tanked along with our portfolio in early 2020, and we definitely bought more and more into it and doubled down pretty decently, making sure that we bought into it, because we definitely didn't think that the prices were going to stay as low as they did, and sure enough, they did not. Now the real question is whether or not it's all been priced into Shell at this point, because obviously Shell has come up pretty significantly since then, but the oil price has come up even more, so it's kind of arguable whether or not share was supposed to move up more, or if Shell has been lagging it a little bit. Is it SHLX in your country? In the United States, it's SHEL. I'm talking about primarily the ADS because I'm American based. Not sure, but let me see. Here's the 10K. Oh, see, it's HCL, American Depository Shares. Yeah, see, it looks like it's all SHEL for the other guaranteed notes, but yeah, SHEL is the one we're looking at today. I have no real idea which one the other one is. Just lost the chart I was gonna look at. It's in here somewhere. Their 10K is so large. There's just so much in here. I mean, maybe at some point, but today we're doing this one. All right, so before we get into the companies today, taking a look at the list of other companies that we are planning to do in general. KR and Barrick have not put their 10Ks out. Those are the last two companies that are in my portfolio currently that we haven't been able to put the 10K out on to be able to have our more recent valuation for, but I assume that both of those will be coming in at some point in the near future. So for Friday's stream, it's likely that we'll probably be doing one of these two instead, unless one of those two comes out. I mean, I don't really know what SHLX is either, so I don't really know what the difference is. It's like, I'm only concerned with this one. I don't really care about SHLX. I don't even know what that is, but I'm not gonna look it up now. If you don't even know the difference, then I'm not sure I should bother to know the difference either. Anyway, so getting into the company specifically, they have three main segments that are operating around petroleum products: the integrated gas segment, upstream segment, and the oil product segment. So the integrated segment's mostly like the midstream, moving through and processing and what's it called, the refining process, while the upstream is more of the production and exploration aspect of it. Oil products is more of the distribution, but that also includes a series of other petroleum products, and that's where the lion's share of the revenue is coming from. They also have a chemicals segment for a lot of the leftover portions of their business, which makes up about 6 to 7% more. As far as geographic segmentation of their revenues, we're doing something a little bit differently with Shell than we do with other companies, because of the fact that it is an oil company and it's a global oil company. It sells all of its oil into a global market, which means that we don't really care too much where the revenues come from geographically. We care where the oil is, because that's going to be where the risk comes from. The risk comes from the fact that they have to pull the oil out of the ground in specific locations. So instead, we have basically all of their oil reserves as a percentage by continent here, and that's going to be how we segment off the revenues, which gets us to an equity risk premium of 5.83 for them. Yeah. Anyway, continuing on. Also, their book debt, we might have to make some adjustments to this because of some of the weird ways that they are capitalizing things in their balance sheets. They don't really provide interest rate information in a very elaborate way. Instead, they basically just give a capitalization amount for the leasing amount, which they claim to be 4%, which does line up with the amount of interest that they paid in the most recent year according to the income statement. However, the actual book listed amount comes out to be close to 70 billion if you subtract out the implied interest from that particular area. So we might have to make some adjustments to this after I put the rest of the numbers in, but maybe not. I'll just take a look at what the market value of the debt comes out to be. As long as it comes out to be appropriate, then that should be fine. Now we're also going to have I put together a little bit of a model for how I'm going to project oil prices and how that's going to get me the revenues that I'm expecting for the company. We'll get into that stuff after I finish the numbers. As per normal, I have done 1 year worth of the numbers, and I'll play the fourth quarter earnings call and analyst call while I work.
Welcome to our fourth quarter and full year results presentation. Today, Jessica and I will talk about implementation of our Powering Progress strategy. We will provide insights into our strong Q4 and full year performance, and we will tell you how we plan to improve our delivery even further in 2022. A little over a year ago, I hoped that 2021 would be a much calmer year than 2020. Well, it was not. COVID continued to have a major impact. Cost of living went up, supplies across the world were disrupted, all affecting our everyday lives and work. This was challenging. But I also saw great resilience last year, in and outside SHEL. Now, extraordinary times call for extraordinary measures, and we made 2021
okay, that makes sense.
From launching our Power
Yeah, I mean, they have like 30 or 40 subsidiaries. That's basically how they operate, so that makes sense.
And invested in the energy transition. So let's look at our
some of them are tradable, but I definitely don't really know which ones are tradable or not. I'm just looking at it from top down.
And in July last year, we stepped up our dividend to a sustainable and a more meaningful level in line with our cash generation. And in 2021, we also announced share buybacks in the amount of $3.5 billion. And today, we have launched an $8.5 billion share buyback program, and we expect to increase the dividend for Q1 2022. More on this later. We also have made measurable progress with another goal of our strategy, achieving net zero emissions. In October last year, we announced that we will halve our net absolute scope 1 and 2 emissions by 2030, and this is compared with our base year 2016. Since 2016, we have also made good progress on reducing the net carbon intensity of the energy product.
Yeah, see, like if you look right here in their income statement, they have the main line of the revenue and the share of profit of joint ventures and associates. A lot of the mainline revenue is actually comes from subsidiaries, and then some of the subsidiaries are actually part of joint ventures with other groups. As well as the non-controlling interest that they have to pay out each year. That's effectively more dividends that they may be paying out to people like that midstream partner. Yeah, they have like I said, like 30 of those partners or something.
More than 55 projects in 20 countries, rising to challenges such as reforestation and conservation. Powering progress also means powering lives, for example, by supporting an inclusive society. And we now have some 30% female representation within our 1,250 senior leadership positions. So I've talked about the progress we made, and you can find more examples on shell.com. But I also want to give you an idea of what this progress adds up to. How does Shell look different today? Now, to start, Shell has become a much simpler business, focused on customers. We have reorganized, and we are on track to reduce around 7,800 jobs and save some $2 billion annually by the end of 2022. That's compared to 2019. And last year, we've also been transforming our business. So in our upstream pillar, we further focused our portfolio. We strengthened our positions in core regions like Brazil and the Gulf of Mexico, while also selling several assets, including the Permian in the United States. And in our transition pillar, we announced divestments of 8 of our refineries around the world, and we are transforming the remainder. In our growth pillar, we are strengthening our leading position in marketing by investing in charge points for electric vehicles and in convenience retail. And we are growing our renewables and energy solutions business by securing access to electrons and expanding our customer-facing businesses. Supporting our customers.
Yeah, I don't know if you've ever looked at midstream pipeline companies before, but that's pretty typical for them. They typically pay out most of their cash flow in the form of dividends, and so basically it just gives you like a way that you can get access to the cash flow from those assets. I have looked at that space before, even though I haven't looked at that particular one of Shell's. And no, I haven't looked at Zim before. I believe you brought it up in a previous stream, and I think it's on like one of my lists to look at, but I haven't gotten around to it yet.
And renewable energy. So in 2021, our business became simpler, became more focused and integrated, one that invests profitably in the energy transition. Over to you, Jessica.
Thank you, Ben. This quarter, we've delivered strong results. We generated $11.1 billion of cash flow from operations, excluding working capital movements. Our adjusted earnings were $6.4 billion, mainly due to strong results in integrated gas. The scale and scope of our LNG trading and optimization portfolio allowed us to capture opportunities in the current price environment. However, the ongoing supply issues have not been fully resolved and are likely to provide some challenges in the near term until we bring in additional feed gas supply. As Ben said, 2021 was indeed a very strong year for us. For 2021, our cash flow from operations, excluding working capital movements, was more than $55 billion. And our organic free cash flow was around $27 billion. Our adjusted earnings were some $19 billion for the year. In 2021, we had an underlying OPEX of around $35 billion, delivering on our target and maintaining cost discipline in a higher price environment. This strong financial performance is a result of the way we have reshaped and focused our portfolio over the last years. Through our focus on value over volume, our business has generated around $6 billion more in cash flow from operations, excluding working capital, compared with 2018, when the Brent price was similar. And our capital discipline, combined with solid financial performance...
Yeah, well, I can only look at so many stocks per day, man. So, you know,
in 2016, our net
lots of gains out there to get. I hope you were collecting on it.
In 2019,
maybe I'll get around to it eventually.
Was introduced. By year end, we reduced net debt to $53 billion, substantially
Lots of fish in the sea.
Resiliency. Our disciplined capital spend, consistent high cash generation, and strong balance sheet provide us with a solid foundation to deliver significant shareholder distributions and lead in the energy transition. The amount we are spending on the energy transition is increasing significantly, improving Shell's emissions profile while enabling our customers to achieve their emissions targets. In 2022, over 35% of our total OPEX and CAPEX spend will be dedicated to producing low-carbon energy, as well as non-energy products for our customers that generate no Scope 3 emissions, and securing solutions for hard-to-abate emissions. We expect our energy transition spend to constitute 50% of our total spend by 2025. Looking ahead, from Q1 this year, we will report our renewables and energy solutions business separately from integrated gas. Oil products and chemicals will be reorganized into 2 segments, marketing and chemicals and products. The new reporting segments align with our Powering Progress strategy and provide additional transparency in our growth pillar. A critical part of our performance is safety. And here we had mixed results. We've made improvements in some areas. For example, road safety, where in 2021, we reached 1.2 billion kilometers without injuries in Shell-operated ventures. But we had a particularly painful experience in Nigeria this year, when 6 people were killed in a security incident. This brought our fatalities to 8 for the year. Each of these is a tragedy, and while we have significantly reduced injuries and fatalities in the last decade, we must and will do more to reduce the number of serious incidents. From an operational excellence perspective, Shell continued to overcome extraordinary challenges to keep our assets running and our projects moving forward. Despite considerable worldwide supply disruptions, through our unique ecosystem of supply chain partnerships, we move materials and equipment on time in over 80% of cases, compared with a market average of around 35%. Our recovery from Ida and the U.S. Gulf of Mexico was impressive, achieving a restart across our platforms safely and ahead of schedule. Our project delivery in upstream and integrated gas, including well delivery, continued to lead the industry for 4 consecutive years, according to external benchmarks. As our results show, Shell is delivering, investing, and changing. We are generating strong earnings and cash, bringing real energy transition solutions to the market, while increasing shareholder distributions. And now, back to Ben.
Thank you, Jessica. So we have looked back at our strategy delivery, our transformation, and our strong performance in 2021. Because of our delivery and resilience, I am confident about the future. So let's look ahead. We are accelerating the pace of our shareholder distributions in 2022. And as I mentioned earlier, we have announced an $8.5 billion share buyback program for the first half of 2022. These distributions are around half of our CFFO over the previous 2 quarters. And excluding the Permian-related amount, the shareholder distributions announced for the first half of the year are expected to be in the higher end of the 20 to 30% CFFO range. We also expect to increase our dividends by around 4% for Q1 2022, bringing our quarterly dividend to 25 US cents per share. Following its peak in 2019, our oil production declined by around...
It's worth noting that if he says that they're at the upper end of the 20 to 30% CFFO range that they want to hit with their dividend, then leading into the 4% growth rate that they are saying that they want to hit, they might have to go a little bit slower than that in the future to keep that long-range target. Either that or they're expecting profits to move up even more in the near future.
Will be disciplined and will be measured. And more than half of the increase is expected to go to our growth businesses.
Admittedly, probably that second part.
With these investments, we will ensure that our financial delivery remains strong in the future, so we can thrive through the energy transition and provide significant shareholder distributions. Thank you.
Well, welcome everyone to the live Q&A on Shell's full year and fourth quarter 2021 results. We continue to deliver strong cash flows and earnings while we are progressing our transformation into a net zero emissions business. This performance is of course the result of the strength of our strategy delivery and our portfolio. That's what we call powering progress, profitably and purposefully. Now today, Jessica and I will be answering your questions, so please could we just have 1 or 2 each, as usual. And with that, could we have the first question please, Cecilia?
Thank you. The first question comes from Oswald Clint from Bernstein. Please go ahead.
Good afternoon. Thank you very much. Ben, could I ask just one question to you? It's really one of your slides today. You're talking about 5,000 businesses seeking net zero. And it feels like to me that, a majority of these don't really have a good idea how to get there physically. And it's clearly a massive opportunity. And, we've gone as far to think of Shell as this future energy Amazon type platform. So perhaps I'm dreaming, but, with that context, I wanted to get you to describe perhaps a typical conversation you and your teams are having with these businesses at the moment, and really how you're doing it profitably. Is this products you have on the shelf, or you're looking into products that you still have to make and the profitability is just not quite as clear? That's the question, please. And then Jessica, please, if I could just ask about CapEx guidance this year, and specifically chemicals and products and the marketing divisions. Both of them look around $5 billion. Obviously, depreciation's less than half of that number in both. So I wanted to get a sense of some of the bigger projects or investments or buckets that are in those 2 businesses this year. It feels pretty high levels of spend. And I just want to understand, is it biofuels capacity? Is it EV chargers? Is it stations? Obviously, there's some M&A potential in there. So if you could just, talk about that, please, it'd be fantastic. Thank you.
Yeah, great. Thank you very much, Oswald. Yeah, indeed, 5,000 companies, and of course, many more coming. Many companies, of course, have been very clear in their mind that they need to get to net zero and are ready to make that pledge, but not necessarily always quite knowing how they will get there. What we have been doing, Oswald, as I've said before, is we reorganized the company and we are now looking into the market on a segment-by-segment basis, sector-by-sector basis. And these 5,000 companies and more, of course, are spread over a number of sectors. So the discussions will be different. If you're talking to an airline, you will have different type of discussions than where you're talking to a taxi fleet company or where you're talking to a tech company. And sometimes, of course, they are quite conventional discussions already. Well, I buy lubricants from you, but I also want to do other things. Can you help me? And quite often, of course, it's then a matter of bringing the might of Shell to that customer and say, well, let me listen to your challenges and let me find out what solution would work for you. Sometimes these discussions, of course, run higher up in the company and all the way up to, of course, in the EVP for that business or the director for that business. And in some cases, I get personally involved talking to the CEO of these companies as well. If you want to do some strategic deal with Amazon, quite often it does require me to also get involved. But the discussions are quite often in the discovery, and rather than us telling this as the solution that we have for you, it is more trying to find out what is the challenge that you need to overcome. And more often than not, we find that we have a formidable range of solutions to bring. Quite often, of course, then meaning that we also have to take some bold actions by building the supply chain to that customer, or seeing the new opportunities like in hydrogen, for instance, talking to trucking companies about how hydrogen can help them out is great, but it does mean that we still have to deliver on delivering the supply chain, of course. So it is a little bit variable. It depends a little bit on what type of company and what type of sector. But it is a different type of dynamic than the dynamic that we had, of course, for our first 130 years, which was all about we can make these products.
Our first 130 years. Not a lot of companies get to talk about their first 130 years.
Right. So thank you, Oswald, for the question relating to CapEx and our guidance for the year. Just to make sure everyone's aware, we've indicated that CapEx for 2022, we're looking at $23 to $27 billion. We expect to be on the low end of that. So that's somewhat of a step up, but I think a modest step up from what we spent in 2021, around $20 billion. So the first thing to highlight in this is that we want to grow our business, and Ben spoke a bit about some of the areas where we're looking to grow the business, but we want to do it in a measured way, and we want to maintain the capital discipline that we've established in the company over the last couple of years. We also get a lot more for every dollar we spend, and we certainly want to have that continue going forward as well. In terms of where that money will go and why the step up that you're seeing in our chemicals and products business, as well as our marketing business, Oswald, you touched on, I think, all of the main points that I would like to raise. So in our marketing business, our mobility business, you'll see a step up in relation to our EV business. There's a lot of great things happening in that business as we expand our charge points around the world. We've made a lot of progress in China. We've made a lot of progress here in the UK, and feeling very good about that business and looking to continue to expand that business to meet our ambitious targets for the middle of the decade. You also mentioned biofuels. That does show up in our marketing spend as well. We've sanctioned two HEFA plants, so that we can provide our own source of biofuels. Those investments will start kicking in the next couple of years. And as you mentioned as well, we are building out our sites in places like China, India, and other markets. So across that spectrum of our marketing business, that's what's contributing to that slightly higher amount of CapEx being allocated. In our chemicals and products business, the main contributor to that is our finishing up the Pennsylvania Chemicals project this year, which should hopefully be up and running by the end of the year. And that's really the primarily large piece of CapEx that you'll see in that part of our business. The rest is mostly around run and maintain. We're also doing some energy transition spend in that money, as well as we try and improve our own Scope 1 and Scope 2 emissions in our chemicals and refining portfolios specifically.
Okay, thanks, Jessica. Thanks, Oswald. Cecilia, who's next?
Lydia Rainforth from Barclays, please go ahead.
Thanks, and good afternoon. Two questions, if I could as well. The first one, Ben, on your start of year message, you talked about going faster, being bolder, being more daring. Can you help me understand what that actually means in practice, and is that different to where you were thinking a year ago? And then the second one, just to come back to this idea of energy as a service and the 5,000 companies, is the idea that that helps you build market share? Or is it a case of actually, if you're reducing emissions by, let's say, 1 million tons, that the margin for you would be $10 a ton? So almost trying to think about it as a carbon management business. Thanks.
Great questions, Lydia, and thanks for reading my notes. I always read yours as well, of course.
Oh Jesus, what a softball pitch question there. It's like, let me rephrase and reframe your business in the most picturesque, perfect, convenient way for you possible.
Tremendous opportunities in this energy.
So funny.
But that do require perhaps a slightly different mindset. I talked earlier on about this customer back, and we'll talk about it in a moment as well. But it also means that people have to think different about what is the opportunity and what risk and how do I take that risk intelligently. And let me just give you 2 examples. So take, for instance, hydrogen. If we want to build a new hydrogen plant, you can't take the conventional approach of just saying, let's do some analysis about market developments in this area and how can we build this up and what will happen, etc. The market isn't there. So does it mean that we then can adopt a build it and they will come attitude? No, not entirely, but maybe a little bit. Maybe we have to understand, can we shape that market as it comes into being? What risks can we take as this market is building up? What do we do with the hydrogen before all these customers start showing up with the hydrogen trucks, if that is what we are aiming for that particular facility? So you need to have a slightly different mindset. We talked about customers getting to net zero. Sometimes these discussions we have with customers about what do you need, what can we do for you, will also bring things out where we just say, well, yes, I think we can do that. We don't have that ready or handy for you, but we're happy to commit to it. And that doesn't mean that we basically go short on everything. We can't do that either. But you can take intelligent risks and say, okay, fine, we're ready to commit that. Let's work with that customer. How are we going to build that supply chain for that particular
All right, so there's 4 years done.
And as
We'll do 1 more year, and then we can cover
way of dealing
a little bit of a 5-year historic trend.
Than we are used to, of course, in, shall we say, the somewhat old world where we basically had more conventional planning tools. Now, on your second question, which is very much related to it, Lydia, if we provide energy as a service, or if we do customer back, indeed, it does mean that we develop new types of customers as well. Does it mean that our share can grow? Maybe in some cases, yes, absolutely. But I predominantly still look at that as basically high grading the quality of our portfolio of customers and products. In years to come, we will find that we have to put real carbon constraints on the product portfolios that we put out there. And we have to find good ways, and we are finding good ways, therefore, to reform the demand that we are serving from a higher carbon demand to a lower carbon demand, while at the same time actually upgrading the cash flows as well. That is what the energy challenge is all about for us. And therefore, making sure that people look at these opportunities as upgrade opportunities is as important, if not more important, than simply growing market share. But probably a little bit of both will happen, because before the market will completely transition to a low carbon market, it will just be adding low carbon demand onto existing demand as well. So it's a little bit of both, but for me the high grading, Lydia, is the more important objective to pursue. Thank you very much. And Cecilia, can I have the next question, please?
The next question is from Martin Ratz from Morgan Stanley. Please go ahead.
Thanks for taking my question. The first one I wanted to ask is, it's much more practical. So we've seen huge rises, of course, in JKM LNG prices. And I know that historically your LNG portfolio is largely built around oil-indexed contracts with S-curves that we don't really know. But nevertheless, there is still a significant chunk that is on a spot basis. And
yeah, if you look closely at the production costs for their natural gas portfolio versus the realized prices they get, if you're looking at just natural gas alone, they just take losses on natural gas, like wholesale, and after 3 years. I was doing a little bit of a look at that last night. All of their profit comes from petroleum specifically. So natural gas is more of like a service that they're providing in order to keep customers.
And then secondly, I simply wanted to ask your assessment
at this point anyway. I mean, prices could rise to the point where it becomes profitable, but at this point it's basically just a drag.
Often, sit on more real-time data than many of us. What is your assessment of how demand is coming back, is not coming back, where is it accelerating, where is it stalling? I was hoping you could say a few things from a macro perspective.
Yeah, thanks, Martijn. Let me start with the second question. Jessica will take the first one. I think recovery of oil and gas demand, of course, is very much in evidence. If you just look at how fast Particularly the East, of course, has recovered. You can say it's booming. Yeah, a 12% rise in gas demand in China. Tremendous pull there for also for LNG. And of course, many of these things have to do with just the tail end of the pandemic. But then, of course, also the drive for decarbonization, which I think we will see more and more of. And a very important part of decarbonization is conversion of coal-fired power to gas-fired power, but also, of course, industry, residential heating, etc. Many of the demand drivers is not just LNG or gas for power generation. 2/3 is actually non-power generation, and therefore general economic activity is also driving a significant part of it. I think the sector that stays behind a little bit, I would say, is more in the liquid side. So it is still aviation. I think many of the other liquid sectors, road transport, shipping, are back, and we see actually quite a few constraints. And if you look at the overall liquids demand, of course, you'll see, Martijn, that is largely sort of restored to where it was from before the pandemic. I think the big point, of course, is not so much the demand recovery. It is actually how supply is lagging, because in the meantime, of course, the industry has, with capital discipline, but also to preserve financial resilience, been quite parsimonious with investments, and as a result of it, we actually.
All right, so we'll pause there to take a look at our 5-year trend. As per normal, we'll start at the bottom with the sales to capital ratio. We'll actually take a look at the industrial expectations, which I didn't really mention when I was actually taking a look at the segments at the start. The industrial expectation for their sales to capital ratio is 0.61 relative to relatively decent adjusted net margin of 12.11 for the overall mix of their overall business. And that's based off the numbers from last year. Unlevered beta of 0.96, which is pretty interesting to see. We'll see what it looks like after their overall leverage. But if you see their actual sales to capital ratio over this 5-year period, we have something like 1.16 with a 1.04 in the more recent 3-year average. So definitely a pretty high sales to capital ratio, all considered relative to their industry. And that has to do partially with the relatively good managed decommissioning of assets that they've had over a decent period of time, as well as the spike in revenues, obviously, in the most recent 2 years. If we move further up the line, you can see on the PE basis, they have been trading pretty much all over the place. But right now, technically, relative to the most recent year of earnings, they're actually trading relatively cheap. But obviously, that comes into question of whether or not those earnings will be sustained in the future years or not. RNG adjusted PE also relatively cheap, but we have to see further back with once we have the rest of the numbers in. Getting into the balance sheet, you can see their shareholders' equity is actually down over this 5-year period. So, they've definitely had to take losses as far as their profits go in a couple of these years. And then also, like I was just talking about, the large amount of assets have been decommissioned throughout the period as well. The retained earnings, you can see, is down as well, a little bit more in terms of percentages. So that basically shows that that's coming off the back of the previous losses. And moving into the overall liabilities, well, you can see that they've actually shifted their liabilities a little bit more from non-current liabilities towards more of current liabilities, while at the same time technically bringing down their overall debt in terms of market cap. However, it is moved up in total dollar terms. So they are moving into a little bit more of an operating type of leverage rather than a financial type of leverage, which can be good, can be bad. I'd say as an oil producer, that's probably pretty decent, considering people are a little bit more contractually obligated to keep working with you based off the fact that they're going to need to make contracts with you again pretty soon. Overall asset base, if you take a look at it, you can see that their asset base has stayed pretty flat relative to this changeover in the assets, which is part of the reason that the equity has gone down. And you can see their property, plant, and equipment has come down, which is as I was saying, the assets they've decommissioned over this period. And total current assets moved up as well, showing again a push more towards a reliance on operating leverage over financial leverage. Looking at the returns on invested capital, pretty decent returns on invested capital over the 5-year period for a company in this particular business overall. However, the business itself is pretty poor. When we shift to a 5-year average, you can see that it's a 6.17% average, which is again not really great. Especially it's pretty all right for their industry, but not great in overall terms. And if you look at the excess returns, it's actually in negative territory. So we wouldn't even really need to go look at their cost of capital and see that it is in fact in negative territory. Though again, I might have to adjust some of the things about the cost of capital once we're done. And return on equity is only barely above return on invested capital, which shows that the debt that they've taken on, they've had a decent amount of debt, but it obviously hasn't turned into superior equity returns for them. Over the 5-year period, the total amount of cash flow that they could have paid out to their shareholders is $8.5 billion. And overall on net, they've paid out $14 to $15 billion. So yeah, they've overpaid their shareholders, but obviously they have cut their payments to their shareholders in the most recent 2 years. You can see that in the most recent 2 years, it's been, wait, that was actually an average number, my bad. An average of about 15 billion per year versus an average of 8.5 billion in cash flow over the period. So definitely overpaying, but you can see like the average of the most recent period is about 9.1 billion paid out to shareholders, while the average of the 3 years prior to that was 18.8 billion. So they've cut their overall payments to shareholders in half, while overall the cash flow has actually moved up during the period. So giving them a good amount of room to bring that leverage down. You can see, however, that their net capex is moving down over time, and adjusted net capex as well, which is basically the total combination of all of their exploration and amortization, as well as the capitalization and depreciation, all rolled into one figure. You can see it was in positive territory, but not super high, and then it's moved into very negative territory in 2020, and still in negative territory in 2021. So they've effectively been de-investing, not investing more over the entire time frame. Then maybe that'll change in 2022 because of the high demand, but well, it's hard to say. Looking at the adjusted net margin, we can only really look at the most recent couple of years for an accurate measure because we haven't done the rest of the capitalization, but we will get into that in the near future. Good to see that the tax rate is in an appropriate range, though. We do want the tax rate to sort of be around 30 plus range because they do have a relatively high effective tax rate, adjusting for all of the geographies that they operate in. Adjusted, the reported income margin on average over the entire 5-year period comes up to about 2%, so not very high overall. Obviously, they have negative numbers in there that throws that number off pretty significantly. So we'll get back into the numbers while I do the last 5 years, and I'll play the call again after work.
We see a significant struggle for supply to keep up with demand, and I think that is going to be with us for some time to come. Jessica?
Great. Martijn, in terms of the LNG industry today and what we should be expecting going into the first quarter, indeed, an absolute standout quarter for our LNG business in the fourth quarter. Really great to see what that business, the portfolio, and the capabilities of our trading and optimization team can deliver in these circumstances. It is relatively unprecedented, both in terms of the absolute level that prices have achieved, but importantly also the duration in which these high levels of prices have been maintained in the industry. So that's really unprecedented. There's reason to believe that some of those dynamics could continue for the reasons that Ben had just mentioned. There are genuine supply issues that are being felt across the energy system, and that does put pressure on gas prices. We're certainly seeing that in Europe. And in LNG specifically, and that could continue for some time in terms of into the first and second quarter. In terms of SHEL specifically, we managed extremely well during the fourth quarter. Some of the supply issues that we had in the third quarter continued to the fourth quarter, but the team worked hard in terms of managing some of those risks. I think learned a bit from the third quarter, and that learning from the third quarter and the innate power of our portfolio, and as I said, the capabilities really came through. Going from almost 2 billion of earnings to 4 billion of earnings over that quarter was realized in two parts of the business. Part of that came through the asset side of the business, and the other piece from the trading and optimization side of our business. So it's not just an entirely trading story that you're seeing in those earnings. It's also the positive effect of the macro environment on our assets as well, and so that should continue. The trading and the optimization piece is a bit harder to predict. It is very dependent on the circumstances in the market and the timing of cargoes, et cetera. Again, the team did a stellar job in the fourth quarter of really optimizing that. I'm optimistic that can continue through the first quarter, but we still do have some supply challenges that we're continuing to manage. I think most of those will be behind us by the end of Q2. So I think there's favorable conditions for the first quarter, certainly from our asset perspective. The trading side, again, I think we proved our strength in Q4, and I hope the team can achieve perhaps not quite the same levels, but almost the same levels in the first quarter. I think the conditions are there. I will point out, though, there's two things that are playing out. In the first quarter, we have maintenance and Pearl in the first quarter, so please keep that in mind. And of course, Prelude, we're bringing that back online after having a power interruption issue in the last quarter.
Okay, thanks, Martijn. And bear in mind also, of course, that in February we'll do our annual LNG update, while we'll be hosting it together with Steve. So please reserve some questions for them as well. Cecilia, who's next?
Biraj Borkhataria from RBC, your line is open.
Hi, thanks for taking my questions. First one's on the buyback. On a underlying basis, excluding the Permian proceeds, looks like you're at the top end of the 20 to 30% payout on cash flow. Using the last 4 quarters as a reference point, I suppose if the macro holds, the cash flow numbers move up. But can you comment on your thinking on how you're deciding where you fit in that 20 to 30% range? Presumably, debt will keep moving lower, so the balance sheet's not a constraint. But I'm just trying to understand how you as a management team and a board are thinking about it. And then the second question is actually on your balance sheet. You're sitting on $36 billion of cash, and I think you've prepaid some debt in the fourth quarter, which resulted in some penalties. But I suppose in the grand scheme of things, still made sense. But just conceptually, sitting on that much cash in this environment seems a little bit odd. So I'm just trying to understand your thinking there and whether we should expect any early repayments for 2022.
Yeah, thanks, Biraj. I'll bite off the top end, and then most of it will be answered by Jessica. I think you worked out the percentage correctly. It's when we said it's higher up in the range, it's somewhere between 29 and 30. So well done there. And of course, you have to bear in mind this particular financial framework was set out when there was a different outlook that we were facing. So let's first of all deliver that first half of the year. We've been very clear about what we want to do. Also bear in mind, of course, at this stage, buying back 4 billion per quarter is probably sort of the maximum run rate that we can do, unless we ask for permission to also buy off market, which is something that we are indeed considering. And then let's indeed take a look on how things play out and whether that upper limit is still the right way to think about it. We have said we will pay out on a historical basis. So we don't pay out prospective cash, we pay out cash that we have earned. And I think therefore it's appropriate for you to just wait a little bit until we are at the cusp of Q2 and we come back to you with what's going to happen next. But Jessica, quite a few more questions unanswered, so why don't you take them?
Thanks, Ben, and thanks, Biraj. Indeed, so 2021 was an exceptional year for us in terms of cash generation, and $55 billion of CFFO excluding working capital, 40 billion of free cash flow, 27 billion of organic free cash flow. These are obviously material amounts being generated by the company, reflection of the strength of our portfolio, the strength of our operational excellence and our performance really coming through, particularly in IG and upstream in the last quarter. That has put us in a very different place than where we were just a year ago. We've paid down our debt by some $23 billion. I can honestly say we didn't anticipate that. We were still in the 40s in terms of Brent prices as we were leaving 2020. And so we're in a very, very different place than we expected, a very strong place financially. And so that does set a different context in terms of how these decisions are being made, whether it be the level of share buybacks, our CapEx levels, and the balance sheet levels. I think the balance sheet right now is very strong. We're comfortable with where it is. So it is a less of a priority. The strength is always a priority, but in terms of needing to allocate disproportionately to balance sheet, I think we can step a bit back from that. And it's more a question of how we want to prudently, appropriately, in a measured way, grow CapEx, and that's why we're at the lower end of the range of 23 to 27. And then the share buyback, which Ben just spoke about, considerable cash being generated, and that's what's really driving the $8.5 billion share buybacks that we've outlined for the first half. The level of cash that we have on the balance sheet is a reflection of where we were a year ago and being well prepared to manage any volatility and any risk and ensure the financial resiliency of the company. Again, we weren't anticipating Brent reaching 90 this year, and that's what the balance sheet reflects and the cash levels reflect.
Some of us
We did
did.
do some early redemption of debt that caused an interest expense that shows up in corporate this quarter, which some of you may have seen. It was a positive MPV transaction for us. We will continue to look at opportunities to optimize the balance sheet, optimize our cash levels, and if we see similar opportunities, then we may in fact do that. But we'll do that. We'll let you know when that happens, rather than kind of indicating that prospectively. But I think hopefully I've given you a sense of some of the considerations that we're making across the spectrum of capital allocation.
Thanks, Jessica. Thanks, Biraj. Cecilia, who's next?
Irina Hermona from Societe Generale, please go ahead.
Thank you very much, and congratulations on these excellent results. My first question...
I haven't done Foot Locker recently. I did have a Foot Locker valuation last year, but it's not since their recent 10K or since their recent major drop in price. I do think that I might do them in the near future. I haven't taken a look yet, but I'm aware obviously that they came down pretty hard, and I have been curious to look at them again. So maybe in the near future. As I said at the start of the stream, we are quickly running out of the companies on my list, so I will be adding more companies to the list in the very near future. But yeah, I've definitely been considering Foot Locker. But as of right now, I don't really have an accurate valuation. You could go watch my old valuation of it, but it's probably not super accurate anymore.
In this extraordinary price environment, it's quite likely that price views will begin to diverge. Others might see more value in some of your assets than you judge them to be worth to you. So would you contemplate some other additional sizable asset disposals driven by value creation should someone offer you a good price?
Thanks, Irina. Let me take the second one. And Jessica, if you talk about net debt and the position in the cycle, which is an interesting perspective as well. Of course, we always look at asset disposals, Irina. We have to take a view on how do we keep our portfolio fresh, which are the assets where we believe they are better off in the hands of others, and where do we believe we want to put our new investment dollars? Is that in continuing to harvest the value left in an asset?
Yeah, don't worry. We'll take a look at it before I close out. I usually try to close the stream looking at the list a little bit.
Throughout the cycle, we permanently manage a funnel of $10-20 billion of divestment prospects, which we can activate, pull forward, push back, depending a little bit on where we are in the market and the cycle. So yes, you can expect us to continue to work on divestments. Not quite at the $15 billion level, I would say, every year, but across the cycle, work with an average of $4 billion per year is not a bad place to start. But indeed, with a very strong macro, it does make sense to think harder. Is this the moment to harvest some of the late alive assets that are probably better off in the hands of others? Jessica?
Great. Irina, thank you for the question. In terms of balance sheet strength and kind of the ultimate destination, as I mentioned, we're really pleased in terms of the improvement that we've seen on our net debt over 2021, down some 23 billion, as I just mentioned. And so we're much further ahead on that journey than I expected us to be a mere 12 months ago. So we're comfortable with that. Now, a bit more strengthening is not a bad thing. It certainly gives us financial resiliency and flexibility. If nothing else, in the last 12 to 24 months, we've seen how quickly the macro can change from one direction to the other. So I would, while it all feels quite buoyant right now, 6, 12, 18 months from today, we could be in a different position. And of course, that's what we always need to keep in mind with respect to our balance sheet and kind of not get too far ahead of ourselves. So I think we'll look at it quarter by quarter before really making any kind of material adjustments to our capital allocation framework. I think we're in a good place. As I mentioned, the current macro and the current performance of the company will give us, I think, a lot of optionality, if you will, with respect to shareholder distributions. That's a great place for us to be. On the capital side, it does give us more room to grow CapEx, but we're clear we want to maintain our capital discipline. We want to grow in a measured way. We want to prove out business models while also being bold and ambitious, but trying to get that balance right. And so not getting too caught up in the moment when it's when things are really, really high, and similarly not getting too caught up in the moment when things dip down as well. I mean, that's our job. Our job is to work through these cycles, and I think we're in a great position right now in terms of managing volatility, and importantly, being able to fund the energy transition and help transform the company.
Thanks, Jessica. Thanks, Irina. And Cecilia, who will be next?
Our next question is from Michaela Dolovenya from Goldman Sachs. Please go ahead.
Ben and Jessica, thank you and congratulations. I have two questions. The first one is about the EU green taxonomy. It will start to be applied this year in terms of taxonomy eligible revenues and investments. I was wondering if you could give us perhaps an early indication of where you think you're likely to score in terms of percentage there, given how important this is going to be for the ESG strategies of so many European investors. And secondly, cost inflation is the theme of the moment. It's emerging across many industries. It seems like so far in oil and gas, the only area of really material inflation is US onshore. But I was wondering if perhaps there are other areas that are concerning you at the moment. And if we look at your capex increase, which, your guidance is about 15-20% in 2022, how much of that is activity versus price increases? Thank you.
Thanks, Michaela. I'll take the second one, and Jessica will talk about the EU green taxonomy. We see some price inflation as well. Of course, most of the price inflation that is being talked about today is, of course, in cost of living, and clearly driven also by energy prices. If you look into our supply chain, though, it's a slightly different story. I think probably where we see most of the supply chain cost inflation is actually in the renewable space. So wind turbines significantly up, but also battery costs. We see the raw materials there also being significantly affected by inflation at supply chain. That's something that we are watching very carefully because, of course, quite often you bid on projects where you have to take a view on how costs then subsequently will develop as well. That's probably the most significant part. In other parts of the supply chain, depending a little bit where you look in terms of steel or construction cost, other materials, yes, there are inflation percentages, but most of them, if I analyze it a little bit further, it is actually more basic.
All right, 2 more years to go.
We come off a year where
and then we can get into the good stuff.
Because of lowering activity, and now you see a little bit of a recovery. So yeah, you may be looking at an 8% rise in cost, but that's off a 7% drop in cost last year. That's most of what we see in the more conventional supply chains. And if I then look at overall unit operating cost, we are quite still confident that we can continue to drive costs further down from where we are today. So we don't see that inflationary aspect in the supply chain coming through into our cost of operations. On the project side, actually the step up that we are talking about, which is a modest step up, of course, is predominantly activity. So we want to allocate more capital to certain parts of our portfolio. That is not cost inflation. That is simply because we want to do more. And also there, we are quite confident that with all the changes that we are pursuing in P&T, we can continue to drive down costs further. We don't think we are back at where we need to be or where we were 2 decades ago. So also there, more running room to come. On the first question.
Yes, so on the EU taxonomy, first of all, as you're likely aware, Michaela, and because I know you know the subject well, I've read some of the reports you've written on the EU taxonomy, which I think were quite good, by the way. As a PLC, we're not actually subject to the requirements of the taxonomy, but nonetheless, we have had a team in place working to prepare disclosures according to the taxonomy. Once again, as you're likely aware, there's a lot of important details that haven't been sorted out, both in terms of the scope of what's in the taxonomy, but also how to actually practically apply some of the concepts. Nonetheless, we're working through all of that, and I would expect we'll be providing disclosures on that over the course of 2022 and bringing some of that into our annual report as well. So we're fully committed in terms of making sure we understand the intent of it, as well as being able to represent our business in that context. It's another important way of describing or understanding how the world needs to move to a green future. It's an important piece of it, but there's a lot of details that need to be sorted. And importantly, we'll have to see how the market responds to it. And if the market thinks this is a good way of considering whether a company is on the right path or not. Part of the challenge that we have is that there's a lot of very worthy efforts out there that are trying to determine whether companies are on the right or wrong side of the greenhouse gas reduction agenda. Of course, we think we're very much on the right side of that and are trying to drive it with our absolute emission targets for scope 1 and 2 and our intensity targets, where we believe we've taken the full scope into consideration. And we'll continue to report across that breadth. But as society, we'll have to figure out what's the best way for really assessing a company and a company's performance. And taxonomy, I expect, will be one of the important considerations in that area.
Thank you very much, Jessica. And maybe another point to bring in here, which I think is quite important, in determining whether a company is Paris compliant or not. Quite often, the focus on just capital spend is just incomplete. It's just inappropriate. It is actually not just the capital spend; it's also the operating cost, because much of our green agenda is much more OPEX denominated than it is CAPEX denominated. And if you add it all up, OPEX and CAPEX, we spend about $55 billion a year. More than a third of that we actually spend on the green agenda. And I think that's an important point to bear in mind as well. But anyway, thanks for the question, and more to come on this one. So Cecilia, can we have the next one, please?
Our next question is from Roger Reach from Wells Fargo. Please go ahead.
Yes, and I guess good afternoon, good morning on our side of the pond.
Right, one more year to go.
I'd like to hit on two things. One, a question on execution just within the existing operations. Obviously, we've had things like Prelude that have had hiccups. I was just curious, though, as you look across your overall portfolio and with the, I don't know if I call it above normal, but relatively heavy level of maintenance coming in Q1, how that should be considered. And then the second part is to follow up on one of your comments from earlier about a real carbon constraint. I was just curious, what does that really mean to you? Is it, a global price of carbon? Is it piecing together all the regional markets? Is it a tax, a credit? I just, kind of what your thoughts are and what would be the best approach overall.
Yeah. Okay. Thanks, Roger, and good morning to you. Let me take the second question, Jessica, if you want to take the first one, including the one on Prelude. I think, Roger, when I talk about real carbon constraints, it is making sure that we as a business can grow our cash flows while at the same time reducing our carbon footprint. And sometimes, indeed, we will be helped by, a carbon price that may exist in a market where our customers are indeed being encouraged to take low carbon energy products, and therefore we can supply them to them, and therefore we can decarbonize while still growing our business with them. But in some other areas, that may not work like that. So take, for instance, the example of aviation. In my mind, putting a price on a ticket or even putting a price on jet fuel is just not going to decarbonize the aviation sector. What needs to happen there is that we will have to have regional and ideally global mandates on the amount of biojet that needs to be blended into the jet fuel pool. So what I would love to do when this process gets underway, and of course we are building our biojet plants, and some jurisdictions are indeed now introducing blending mandates, but only, small mandates, 5% of biojet by 2030, which is just not enough
if you consider it in the bigger scheme of things. But what I would love to do is to give our aviation business the task to grow their business, but with a lower carbon footprint. So you figure out together with your customers how we are going to bring competitive biofuels to market in a way that they want to buy, need to buy, work together with regulators, making it happen, etc., etc. And a similar story I could tell, for instance, for the heavy-duty trucking sector, where I would love to have our trucking business figuring out how can I grow my business without just selling more diesel. So can we somehow find ways and means to sell bio-LNG, hydrogen, biofuels in general, and how do I work together with my customers and maybe with regulators, depending on which jurisdiction we are working in, to grow that business. So at this point in time, it is a shift from, well, if the opportunity is there, we may actually take advantage from it, to how do I make sure that this opportunity will come? I'm the one shaping it, and I'm actually the one building the customer loyalty and the solution space and the infrastructure very early on in the journey, so that we have lock-in of future profitability. That is what our strategy is all about when it comes to pursuing net zero. And we have this strategy on a sector by sector basis, because it will be different, again, sector by sector. I hope that helps a little bit, Roger, but I'm sure we will be coming back to this in future calls as well. Jessica, operational?
Undoubtedly.
Good morning, Roger. In terms of operational performance, operational excellence is a priority for all of our businesses across Shell, and you would
finally got done with all 10 of the years we wanted to do for our history. Now we can get into the fun stuff. Coming back down to the sales to capital ratio, as I was saying before, you can see that in the past they actually had an even higher sales to capital ratio. So while we were saying before that the industrial expectations for the sales to capital ratio is relatively low, they have a pretty high sales to capital ratio, but theirs is even higher than that in the past, which shows that theirs is actually moving downward over time. You could argue that theirs is moving downward towards the industrial average, but you could also argue that the industrial average is simply moving down and they're still maintaining a pretty strong relative performance in the sales to capital ratio on net. Looking at the corrected PE, you can definitely see that, or at least for the 5 to 6 years where we have pretty accurate numbers, where they were at the end of 2021 is relatively speaking pretty cheap for them as far as where they were trading, other than the fact that the 2020 they didn't have earnings, so that theoretically would have been the cheaper point. But even in the past, they didn't necessarily have super cheap points. So again, it comes down to whether or not you believe that the earnings that they currently have are sustainable into the future in any real way. Looking at the total shareholders' equity, you can see that actually over the entire 10-year period, it's relatively flat. The retained earnings has come down, however. So while the shareholders' equity has stayed flat on the whole of it, the shifting of what the equity is composed of from actual profits to essentially a bulk of other capital being piled in can be shown, which basically shows that the overall industry probably had too much capital in the past, and so now it started to decline. Again, perhaps that capital base needs to be built up now due to the need for investment in the high demand in the space. It's hard to say. Overall, though, you can see that their liabilities have come up, not a crazy amount over the 10-year period, but again, with the shareholders' equity staying flat and the liabilities coming up, that means that overall the assets themselves didn't come up as fast as the liabilities, because the shareholders' equity stayed relatively flat. They basically came up at about the same rate. But you can see that what they do have is more cash now relative to where they were 10 years ago in terms of their overall balance sheet, the percentage of their balance sheet that is cash. But that also can sort of be said for the percentage of the balance sheet that is debt. So in fact, the increase in the balance sheet percentage of debt is increased more than the percentage of cash. So they're a little bit more leveraged than they were 10 years ago, though they were even more so 5 years ago, and now it's in a little bit of an improvement period. The returns invested capital over the entire time frame, you can see it was better in the past, a little bit more shaky in the near-term future. And with some negative numbers in there. If we take a look at the 9-year rolling average, we get to 6.72%, which it makes a little bit more sense. Just under the cost of capital, that actually really makes sense for this particular industry, so we'll use that as our baseline. Overall, the return on equity is only just barely above that, so really only just barely earning any real returns for the equity shareholder, but definitely not a risk-adjusted return in terms of that. We will actually shift this to probably the 5 or 9 year average. I think I'm going to use the 5-year average for the sales to capital ratio just because of the shift in the overall business structure. So we want a little bit more of a near term number for that, even though we'll use the longer term for the return on invested capital, because capital and the profits shifted over time much more in accordance than the sales did. Over the entire time frame, you can see that the amount of cash flow that they could have paid out to their shareholders was $221 billion in total. The amount that they did pay out to their shareholders over that entire time frame is $128.3 billion. So yeah, for prior to this year and the year prior to that, for the few years prior to that, they were massively overpaying. But if you look over the entire time frame, they haven't been massively overpaying, though that does include a decent amount of capital taking on in the earlier part of the 10-year period. Taking a look at the adjusted net capex, the kind of trend that I was talking about, where they used to have a little bit more overall real reinvestment compared to where we have now. If you look at overall the 10-year rolling period, it's not really as pronounced as much. You can see it's a little bit more of a back and forth kind of movement over time, which actually makes the current reinvestment state to appear to be pretty decent. If you look at the average over these entire time frames, the average number for any 1 year would have been a negative $12.8 billion essentially deinvestment, which we can see that the more recent year has been negative 9.6 billion, was much higher than 2020. But either way, the point is you could argue that they're actually in a pretty decent space as far as reinvestment goes. The corrected net margin, we're definitely going to use a longer term rolling number for that, whether 5 or 9, I'm not entirely sure. Let's see, the 5-year average gets us 1.58%, which is pretty decent. I kind of want to use the 9-year average because it's a little bit longer of a period, but the problem with that is it doesn't include the earlier capitalization as effectively as it does for the later numbers. This does bring it up to 2.81 though, so it's not too huge of a jump up, and it's also going to be our base year for forward projections. So I'm okay with using this 9-year average for that. As far as tax rate, sort of a similar situation. I did want to make sure the tax rate was relatively high, but 46 is perhaps a little bit too high because of the way the profit they had to pay out on their loss year was. 37, that's a little bit more in line with where we wanted it to be. So 5-year average is probably okay for that. Taking a look at the interest rate, we have a 4.5% rolling number for that, which is pretty good and reasonable for that. We do actually sort of want a more recent number in terms of the interest rate. In fact, I might even use the 1-year average perhaps, but it'll make a huge difference. Or it probably shouldn't make a huge difference. We'll see how much did it shift. Yeah, see, like not really a huge difference, but it does, I think, make more sense to use slightly the lower interest rate in this particular case. Now we have to go back down to the bottom and do the correction for the market value. As I was saying, I needed to make sure certain things played out correctly. Let's take a look. Okay, so the market value comes up there. What happens if we shift? Just the market value to, yeah, okay, so we'll just go ahead and use this number. Maybe we will use the longer rolling. No, well, 4.5. Okay. So the market value of debt does list a little bit lower than the carrying value that they have on their balance sheet, but it's not too much lower, so I feel okay with that. It's not too crazy of an assumption. Like I said, part of the way that they list their interest rates on their debt kind of confuses the issue a little bit, so I had to sort of make sure that everything makes sense in terms of that. But because of the fact that I don't net out cash, I'm willing to accept that. We can think of this as their full expected actual debt. All right, so now we'll get into the projections that I have made for the revenue. Obviously they're in the oil business, so we're going to have to make some sort of projections and assumptions about what we think about oil prices in order to make this valuation work. I have their 3 years of revenues right here, 2019, 2020, and 2021. And you can see in 2020, the revenues dropped 47 to 48%, going back to a 45 to 46% gain in 2021. That's the revenues that they did for their subsidiaries, their wholly owned subsidiaries within their business. And then the revenues from the joint ventures dropped 50 to 51% in 2020 to then more than double in 2021, getting back up further. So that's all of their revenues and the way that they change over this 2-year period. The average of how much their joint ventures were a portion of their total revenue over the 3-year period was 1.18%. You can see it dipped down in 2020 and then went back up in 2021. Now, the average oil sales price that they supply in their data, which is the price that they were able to realize on the sale of their oil, for their own wholly owned subsidiaries was $57.56 in 2019. And then it dropped to $36 to $37 in 2020 to $64 or so in 2021, which means that the sales price they managed to achieve dropped 36% in 2020, which, as you can see, is less than the amount that the revenues dropped. And then it jumped back up 75%, which is more than their own home revenues, but not as much as the overall joint ventures revenue jumped back up. And then you can see a sort of similar trend for the joint venture revenues as well. Didn't quite go down as much as the overall revenues, but did go back up more, which basically shows that because of the fact that they have operating costs, they still had to pay more things than just the cost of the oil sales during 2020 when they were taking losses. The overall total expected the costs or prices that they achieved during those years was just under $58, $37, and $64 respectively. Now, the costs that they have to produce that oil during these years, they also give us, was $55 or so dollars, $35 and $61 or so dollars respectively. Now you can see that the realized gross profit that they can gain per barrel, this is a gross margin type number, therefore during these years was $2.67 per barrel, $1.74 per barrel in 2020, and then $3.85 in the most recent years. You can kind of see the chaoticness of this gross margin overall. If we actually, I mean, I didn't even do this before, but if we, like, for example, also take this as a percentage of this comes out to 6% or so, which if you compare it to their actual gross margins, their actual gross margins are much larger than that. However, the gross margins that they include a bunch of other sales within their own business to themselves, as well as some other details. Now, we have the average oil spot price for these particular years. In 2019, the spot price of oil was about $56. So you can see that they were actually their overall costs and sales declined even more so than the spot price, and then it was $39 in 2020 and then $68 in 2021. Hey, what's up, Eduardo? Thank you very much. Now I have a little bit of a model that I put together here to show a few different ways that we can project oil prices moving forward. This is mostly just to think about how their oil prices have been over the last several years, and now we'll use this to think about where we think oil can go in the future. In 2017, 5 years ago, the average oil price for the 5 years prior to that was $47.54 per barrel. The money supply, we're going to use a kind of a quantitative theory to come up with this, has increased about 63% since then. So if we multiply it by that, we end up with a price of $77.73. Now the money velocity has also decreased by about 22% during that time frame. So if we adjust that for that fact, then it actually brings that down to 71.07. Now the world production of oil in terms of barrels of oil per day has actually changed during that time frame as well. So if we adjust for the fact that the oil production has come down, then it brings the oil price back up to $73.12. And then if we adjust for the fact that North American production has actually come up while world production has come down, that adjusts our price back downward to $69.49. And the reason why I do that is because this is me trying to come up with a West Texas medium oil price versus a Brent crude oil price. And this company mostly does their projections based off of Brent crude. But I like to do things focused on North America and America because I'm an American. So I'm doing it that way. And then if we also adjust for the amount of miles that are driven in the US, that brings our price back up to $70.68. So this is a really crude, very simple model to come up with what I think oil prices should average for this current next year or so 5 years, 2 years forward and 2 years back on. So a centered average on today of what I think the oil price should be. It's based off the fact of the average price from 5 years ago. So this doesn't mean the oil prices should be $70.68 today. It means it should average around $70.68 or so for the period surrounding now. So oil prices are higher than that right now, but they were also lower than that only a year ago, and then they might be lower than that a year from now. So over the period, I expect the average to be around 70, 71. Now that's just one particular measure that we're going to use. I also like to project oil prices based off of the money supply itself. If we take a correlation of the growth of the money supply against the growth of West Texas Intermediate oil. You can see the money supply grows at just under 7% per year for the last 50 years. If we assume that it kind of maintains that centered rate on average, then I would expect oil prices 5 years from now to be $101.56. If money printing was to double during that period, to double the rate that it's been, which is actually closer to what it's been for the last couple of years, if it stayed at that rate, then we would get up to a high end of $128.72. So I'm going to use those two numbers as my upper bound levels of future projection based numbers. I'm going to use this number that I came up with right here as my kind of centered today based number. And then I'm also going to do a couple numbers based around the most recent past or so. Which is to say that I have the last 30 years of oil prices and the price that it ended at the end of the year right here, and we've broken them into the quartiles. I've taken the lowest quartile of those numbers, so the lowest 20% of year-ending oil prices during the last 30 years, and taken the average of that, and that's going to be our lower bound of oil prices, so $16.80 per barrel for the lower bound. And then I've also taken the average of all 30 of these years, which gets me $48.78 per share for my other lower bound. So there we go. I have my two lower bound numbers, two higher bound numbers, and then one sort of middle number based on today, which gets us 5 future projections of oil prices ranging all the way from $16.80 at the low end to all the way up to $128.72 on the high end. And this is what we expect oil prices to be 5 years from now. That has to be understood. Now, I've also taken an analyst projection number, because we do like to have an analyst-based projection of oil prices. The EIA, which is a pretty common institution used for oil information about the global and US oil prices, their own projection for WTI oil prices in 2023 is $84.98. Now that's only 2023, but I think that's a pretty decent enough estimation for a future price. We don't need to think too much about the fact that it's missing 2 years on there, but I'm using that as my analyst price as well. So between those numbers, I have all 6 future oil prices for my 6 models that I typically make. And then I do a regression of the revenues that Shell has had for the last 10 years against oil prices to project what I think revenues should be based on those oil prices. And that gets me my revenue projections for Shell. So that overall brings me to these oil projections that I have, which is anywhere from $202.8 billion in the worst case scenario to possibly $530.5 billion in the best case scenario over the next 5 years. So with that, we will also move on to the other metrics that we need to make projections on. Those are our base assumptions for revenues. We do have to make assumptions for net income margin, as well as sales to capital ratio and debt to equity ratio. Now with the debt to equity ratio, we could assume that they could easily lose about 1/3 of their market cap, which would be about $130 billion, bringing them possibly down to $260 billion or so. And then they could also easily have to double their debt, which would bring them to like $140 billion, which would still put their debt to equity ratio really kind of in the range of like 50-60% in the worst case scenario. So we'll go ahead and put that number in place. In the best case scenario, there's basically no real way that they're gonna get rid of all their debt, in my opinion. So we'll probably not use 0 for the best case scenario, probably like 10 or 20% or something. Well, they're already at 20%, so probably like 10%, which gets us an expected value of 33% as it currently stands. Let's see, let's maybe adjust the analyst expected number downward a bit and maybe bring this down to 50. That brings our expected value to 27. I think that's a pretty reasonable expectation. Maybe we can shift this down a little bit further. 25. Okay, so that's a pretty reasonable expectation for that. Now let's go and adjust our sales to capital ratio. Now we're gonna assume that under the worst case scenario, a pretty bad sales to capital ratio can probably happen for them, but that might depend on how we look at a few of these numbers. Now, in order for them to actually achieve revenues, they actually do have to put in a decent amount of capital expenditures to pull the oil out of the ground. So even in a situation where oil prices skyrocket, they can't necessarily just have their sales to capital ratio push up to insane levels immediately, because of the huge lag in the time it takes to produce the oil itself. So as much as I'd like to say that, oh, well, if oil prices doubled, they would be able to bring in so much more sales relative to their capital ratio. We can't actually have the sales to capital ratio go up too much relative to where they've generally been in the past. I do think that it's pretty likely that oil prices will stay a little bit high in the more near future, so they'll be able to pay down a little bit more debt, which would bring the sales to capital ratio up a little bit more in the nearest term future. But in the longer term, it can only come up so much relative to sales. Let's see, our current expected value gets us about 1.21. I'm actually probably okay with leaving this down here, maybe at 1. Well, I don't know, maybe we'll not do that. Maybe we'll bring this down to 2, which gets us an expected value of 1.15, which is only just barely above the most recent year period. So I think that makes a lot of sense. Now let's go up to the net margin. That's definitely something that we're gonna have to adjust pretty significantly. And I definitely kind of wanted to save that part for last for a reason. This is where things get tricky. As you can see, over the 9-year period, the average has been, like I said, just under 3%. So we really do want to kind of keep that as a pretty solid basing. However, we do have to take into account the interest expenses that they've had over this entire time frame in general. The average interest rate over the 10-year period, they've had about $3 billion versus the net income average of about $11.5 billion. So that means that prior to the interest expense, they would have had about $14.5 billion, and then the 3%, that comes out to about 20% of the 20% of the pre-tax profits taken away. So there is easily a chance for them to increase their net income margin by a solid 1% above this average just from the interest payments alone. So by cutting them in half, that's not even like cutting them out entirely. So using maybe around 4% as a baseline, I think actually is a pretty reasonable number to use. Let's see, go a little bit. And then, well, we have to take into account the fact that there is higher prices now, and they've also been selling out their assets to bring down their operational costs as well. So for pushing it up maybe to 5 to 6, I think is also within a pretty reasonable range. It can't really go beyond a certain point in a perpetual sense, because even if it did start to get to pretty high margins at some point or another, they would face other problems like other taxes that they may be levied on them in the subsidiary countries in which they operate. It's not so simple as them operating in a country where there are always a bunch of rules about how things operate. They have to operate in a bunch of countries where the governments often have to make deals with companies, and those deals sometimes are subject to change. So you can only accept so high of a profit margins because tax rates often can be readjusted for companies that operate internationally in the way that SHEL does. Okay, so now let's see. Anything else. We might bring the sales to capital ratio up a little bit more. Let's see, where did the perpetual numbers end up? I want to make sure all this checks out. I'm definitely surprised to see that the value is not being as awesome as one would expect. I mean, you know, I expected them probably to be overvalued because my previous valuation had them overvalued. I have been trimming my position on this stock for some time, but I'd kind of been wondering whether or not I was trimming it a little prematurely, you know? So I was kind of curious to see what happened today, but I am surprised to see that the value is looking like it's going to come in lower today than even the one from last year, and not just about the same, which still would have been overvalued. But is what it is. I'm trying to see if I made any other interesting, crazy assumptions. You could probably bring the profit margin up a little bit. This is the part where I am being perhaps a little bit more heavy-handed in the judgment. If you take a look, for example, the more recent year period has a lower average than the past, and I would have been arguing that partially has to do with the way I capitalize R&D expenses and the way that changes over time. But that could also be said that they've been taking losses in the near term future that they won't have to take as much in the future. I don't know. I could maybe push this up to like 6.5. I think that would be about perhaps the limit of where I'd be willing to push. Don't really want the lower bound to be a little higher than 2 because of where we've seen the longer term average for the most recent 5-year period was. So let's see. I think that's probably about right. Let's see. And then, like I said, I might push the sales to capital ratio up a little bit further, but not too much further. Yeah, so like that's honestly doing them a pretty generous favor, and that didn't really change the valuation that much. That really only brought them up a few more percentage. And this is the thing, it kind of comes on the back that they have paid off so much of their debt. They're in a business where the amount of capital investment that is required to generate revenues is extraordinarily high. So by paying down their debt, they're forcing all of that capital expenditure to be paid for by the equity shareholder effectively. And so that's part of the reason that their valuation comes down as much. But either way, it's still come down a lot more than I would have expected during the 1 year, which I guess makes me happy that, like I said, I had been trimming the position. Looks like it was a pretty decent move overall. Okay, so the only thing left really to do at this point is to adjust for the default probabilities, and then we can summarize the overall valuation. Taking a look at perpetual debt load expectations, I can see them paying off the total debt load in the best case scenario, but beyond that we'll use the general amounts used by the default model that I use. And right, so yeah, pretty low default risk then as a result of that. All right. So that's going to do it for ticker SHEL. U.S. Treasury selling today or more recently about 2.14%. It's pretty crazy to see that it's come up that much pretty quickly. It was kind of like dawdling there for a week or two, coming back down below that 2% line, and then it kind of quickly popped back up. I'm curious to see if it'll stay there or not. And then the equity risk premium for mature markets has also been coming up pretty heftily in the last several weeks. Anyway, I digress. Mature market equity risk premium 5.17% as I calculate it. The discount rate that I come up with for SHEL after adjusting for company specific idiosyncratic risks is 9.81%, and they have a dividend yield currently of 3.84%. The sales that they had 5 years ago was $237.1 billion. Sales in the most recent years, $265 billion, which comes to 2.3% or so sales growth for the last 5 years. Sales to capital ratio for the longer term average has been 1.12, which is pretty high relative to their industrial expectations of 0.61. Returns on invested capital over the 9-year period is 6.72%, which is again pretty decent for their industry, but overall pretty poor in terms of the overall the overall cost of their capital that they have to expend. The debt equity ratio I come up with is about 20% for the most recent year period, and default risk about 1% or so. Profit margins in the most recent 5-year or 10-year period on average after adjusting for R&D comes to 2-3% or so, which is pretty low relative to the industrial expectations that we have for them. Good to hear it, Eddie. I myself am probably going to be getting rid of this one, it looks like, but yeah, up to you to make your own decisions on that one. Profit in the most recent year of $18.3 billion. They're currently selling for $49.96 per share. The probability distribution that I use for this this valuation is a perfectly even static distribution. I tend to use this type of probability distribution when I'm doing commodity-based companies where I'm making projections based off of uncertain commodity prices, partially because I don't really want to tilt my expectations about oil prices beyond the targets that I chose. And with that, I came up with oil price targets of anywhere from $17 per barrel in the worst case scenario 5 years from now, possibly $129 per barrel in the best case. An expected value, I come up with $75 per barrel, which you know, for everybody's reference sake, it's currently trading around $100 per barrel as we speak. Sales in the 5-year forward period, I have anywhere from a worst case scenario of $202.8 billion in the worst case scenario to 530.5 in the best case, an expected value of 373.9 billion, which gets us a sales growth of 6.32% per year for the next 5 years. The sales capital ratio, I assume a range of anywhere from 0.25 to 2.25, which gets us an expected value of 1.29. The returns on invested capital, I have an expected value of 9.12, which does get them back over their cost of capital, but only just barely or so. Debt to equity ratios, we have a range of 50% to 5%, an expected value of 25% or so. And default risk overall during the period, we're expecting pretty negligible amount, less than 1% per year. Profit margins, I have a range of 2% to 10%. An expected value, we end up with about 6%, which gets them an expected profit in the 5-year forward period of $25.8 billion. And that gets us a present value price for them of $26.36, which is 47% lower than the current share price. So yeah, I'm pretty overvalued in terms of that. You know, I could be wrong on a few other things. I had been sitting here kind of wondering why Shell hadn't been moving up as much as oil had been moving up. But you know, it could be that these factors weren't fully discounted in, and that the price that it had dropped down to previously was a little bit more reasonable. I mean, like I said, I had about 4 to 5% of my portfolio in Shell a year ago or something like that, and now it's down to like a little over 1% of my portfolio. So you know, I already removed a lot of my exposure to Shell, but I had held on to a little bit just because I wasn't sure how far things would go. But now it looks like maybe that point has kind of come. 5-year forward value targets, unadjusted for the dividends that they pay out, I have expectations of anywhere from $3.78 per share to $999.86 per share. On expected basis, I see $42.07, which implies a negative 3.5% or so per year return for the next 5 years. So yeah, definitely looks like it's likely to have negative returns. I don't necessarily think that would affect it too much. The thing about the switch over between oil with Russia is that they kind of both gain and lose off of that. So I'm kind of calling it a little bit of a net zero effect, because they do also have assets in Russia and they have projects with certain companies in Russia. So they're kind of taking a loss on some of those projects because of this conflict, but they're also able to open up some more profitable areas in Venezuela as you're talking about. So it's a little bit of a mixed bag for them, that conflict. So yeah, that's gonna do it for Shell today. As I had said earlier, I was gonna back over to our watch list to see what we're taking a look at in the near future. As we just covered, we've done with Shell. As I said earlier, I'm waiting on Kroger and Barrick Gold to release their annual reports here in the near future. Neither of them have released it as of today that I most recently saw, but I'm kind of hoping that they do within this week so I can do it on Friday. If not, then I expect I'll probably be doing Quest Diagnostics instead for the Friday stream. And also we will probably be talking about a few of the economic events that they report during the week on Friday as well. We have the Fed chair meeting begins tomorrow, so there's obviously a whole lot of hullabaloo about that, whether or not they're going to raise interest rates or not. It feels almost certain that they're going to do a 1/4 point interest rate, but how the market chooses to react to that or not, who knows? And also, who knows, maybe there'll be a surprise as far as how that all unfolds, as well as the producer price index is also coming out, which I think of as a little bit of a lagged leading indicator on future inflation. So it can definitely be interesting to pay attention to. Yeah, no, I mean, you know, you hold things while they have the opportunity, and then you sell them when everybody else wants them. That's the whole idea. It's like right now everybody wants to take those Shell shares off your hand. Well, you go ahead and let them take them off your hand, and then use that profit to pay for gas. So yeah, it was a good holding. Like I said, I've had Shell in my portfolio for a while, and I've kind of been loath to remove it, but I guess today is going to have to be the nail in the coffin for that. So that's going to do it for us today. If you're watching up to this point, please subscribe to the channel, follow, like, all of those things. You can find all of my social media in the description below. You can contact me accordingly. We're always trying to grow this channel, and we can only do that with your help. Thanks for joining us, Eddie. Good to see you in the chat. Should text me or something. We can chat it up a few other stocks or something like that. Nice to hear from you. But either way, I'll catch you all again on